Hi, everyone. Welcome to our webinar on August 2nd, 2016 from Green Trader Tax, Best and Worst Tax States for Traders, actually decent states too. I'm the presenter and managing member of Green Neuschwander and Manning LLC and CEO of Green Trader Tax. Most of you are familiar with my bio. This is an educational webinar from Green Trader Tax. It's informational only for educational purposes. It's not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Where specific advice is necessary or appropriate, you may wish to consult with a qualified tax advisor, CPA, attorney, financial planner, or investment manager. We plan to offer a recording of this webinar and expressly prohibit anyone else from making one, and it should be complimentary. Let's start with states ranked by population versus our state list of trader clients. It's interesting to see how they overlap. So in column 1 is the most populous states, and you can see California is by far and away the most populous state with 12.13% of the population. Texas 8.37, New York 6.22, Florida 6.19, Illinois 4%. The top 5 states make up 37% of the country, but it makes up over 50% of our trader clients. Look how California actually jumps up to 17%. Texas 11%, New York 10, Florida 8, Illinois 4.5. So it's still the same rankings. Now, California actually is one of the worst tax states for traders, but it's very popular for traders, even with the high state taxes. If you were to look at our clientele and traders in general, many of them come from the high-tech world. They're software engineers or programmers. They write algorithms. They got their appetite whet holding stock options in some of the tech companies in Silicon Valley, and they go on to wanting to have a trading business on the side or as a family business where their spouse may still work in Silicon Valley, or they leave their job and love their home and their family's entrenched and they want to stay in California. We have tax strategies to save taxes. Taxes are not everything. I think that's one of the points that will conclusions that will come out of my presentation today when you look at the numbers. Now, there you go. And number 2 is Texas. And notice that our concentrations are greater than the regular populations. Now, that could be because of the allure of tax-free state. Texas is one of 7 tax-free states for individual income tax, which is the big driving force because traders use pass-through entities. Now, Texas also has a lot of high-tech workers in Austin, and also there's a lot of people from the energy business who got interested in the commodities markets because they were in the energy business. They're interested in trading. They're the wildcatter mentality. Texas has always been one of our biggest states. Now, New York, again, you flip back to high taxes, especially in New York City that has its own tax rates on top of New York State. And I chalk that up to the proximity to the financial exchanges, Wall Street trading. It's a way of life in New York. A lot of people leave those banks and start trading on their own, particularly with Dodd-Frank that ring-fenced trading and didn't want it for their own account. So a lot of traders left to go on their own. Now, Florida is one of the major tax-free states along with Texas. It's even more tax-free, but we'll go over the details shortly. And a lot of New Yorkers, snowbirds, want to move to Florida. Trading is a virtual business. You can do it in Florida. So there's a lot of traders in Florida. Now look at Illinois. Like New York, it's still very populated with traders. Now, the Midwest has done a great job over the last half a dozen years or so reforming their tax systems, their state and local tax systems, where in the past they had some thorny issues with entity level taxes, which were really a pain in the neck and hard to understand. They've just repealed them entirely. And they've gone to flat tax regimes, which are a pretty fair rate. So, I mean, when you add up property tax, sales tax, and some of the other burdens, It's a high cost of living, like particularly in Illinois, but it's a decent tax state. Now, if you look at another worksheet that I have with all 50 states, you'll see the rankings by population. Maybe we'll look at that later on. So let's look at the state individual income tax rates in brackets for 2016. This is published by Tax Foundation. They have some nice maps. Hopefully you can zero in and see this. Notice the gray areas. Those are your 7 tax-free states. Florida, Texas, this is number 2, this is number 4. Then Washington, number 13. But then the other ones are really tiny in terms of population. Nevada, Wyoming's the least populous state. South Dakota. Some people thought New Hampshire was tax-free. It's not. There's a business tax on if you set up your entity for the employee benefit plan deductions, you're going to pay taxes on that. Otherwise, you're not going to pay on the capital gains. Tennessee, it wants to be the 8th tax-free state, but that they don't phase out the interest and dividends tax, the 6% tax, until I think 2021. One of my co-writers in Forbes just had that article. But look at the West Coast, the dark, really dark ones. California up to 13%, New York State plus city. So you can get the concentrations of the higher rates up in the northern Midwest, the Northeast, the Northwest. You get to the southern part of the country, the rates are a little bit more reasonable. And that's why years ago there was an exodus of people from the north to the south, and these Midwestern governors are trying to stop the exodus. I like when there's a flat tax. It's a little less confusing. Depends on how steep the progressive rates are from your state. Does your state have an estate or inheritance tax? Well, you may not pay a federal estate tax because your exemption might be over the 5.4 million number. I think I'll tell you the exact numbers in the PowerPoint. It goes up each year. And with a portability, you can also have that for your spouse. One spouse can pass it to the other. So your estate, federal estate, might be under, after one spouse passes away and the other one does, it might be under 10.8 million and no federal estate tax. But guess what? If you live in New Jersey, the estate exemption is $675,000, the lowest in the country. It's $1 million in Massachusetts. It's $2 million in Washington. So it's one place to live and trade. It's another place where you want to pass away. A lot of people move to Florida where there's no estate tax. Texas, no estate tax. California, that high tax state, has no estate tax. That's kind of nice. Now, some of these states have temporarily raised their exemptions. Others trying to repeal it. So that's covered in this presentation as well. The gray means there's no estate tax. Look how few states continue to have it. Again, that Northeast is a tax problem. I don't know when they're going to wake up to that and stop the exodus of people. I'm a Connecticut resident and I have a second home in New York City, both high tax places. My spouse won't let me move to Florida, and I love the lifestyle in the Northeast. Taxes are in everything. So let's go to consider other taxes. The sales taxes, property taxes, S-Corp and C-Corp taxes. And traders should consider them. Now, when you look at lists from Forbes and other publications about the best tax states for traders or business, corporate tax regimes are a key element in those state rankings, but not in our rankings since traders don't trade in C-Corps. Traders use pass-through entities, including an S-Corp, which is the preferred structure for trader tax status and employee benefit plan deductions. And I focus on state taxes on S-Corps in my rankings and other content. For example, that blog series that I recently finished, the Trader Tax Battle of the States, where I had California versus Texas, New York versus Florida, the top 10, 5 to 10, the top 10 states, Midwest versus Southeast. Then I had New Jersey, Washington, and Massachusetts, and then Nevada versus New Hampshire. I focused on the S-Corps. The blog post just before that series was about how some states can grab you on the S-Corp tax treatment, like California with a franchise tax, Illinois with a replacement tax. And I do cover that today, although I do cover it more in depth in the blog posts. How high are sales taxes in your state? This again is a map from the Tax Foundation. So again, look at this is sort of like when you look at those political maps, you see the blue states versus the red states, blue being Democrat, red being Republican, excuse me. You notice always the concentration of blue on like the coast and in the Midwest. It's a little similar with state taxes, but the big difference is look at Texas, 8.17%. This is an average rate. Remember, a lot of states have a sales tax, but then they give local jurisdictions, including counties and cities, the right to tag on an additional tax. And this is the average amount. And then they give, like, for example, Texas is number 12. So if Texas is not going to have an individual income tax and they have a franchise tax, but it really only kicks in at a very high threshold, catching bigger business, not most traders, and there's no estate tax, they got to get you somewhere. They got to fund the government. So it's sales tax. So you got to say to yourself, do you spend a lot of money? Some traders spend more than they make because their spouse makes a lot of money or they have savings. Usually you can't spend more than your income. So there are a few states with no sales tax. Look at Montana. My niece lives in Montana. She once came to New York when she was a little girl. She shopped around. She picked out what she wanted. She spent an hour doing it. Got to the counter, had the money ready to go, and the cashier said, okay, your bill is this with the 8% tax at the time. She got so upset. She walked out. She wouldn't buy the item. She wasn't used to that. So people get used to certain taxes. So these numbers are in the rankings as well. So now let's get to the main event. Let's do a sound test again. Testing 1, 2, 3. Yes, it's good. Okay. Best tax states for traders. Well, the main thing is that they do not have an individual income tax regime. That's if you have a pass-through entity, it's passing the income and loss to your individual tax return. It's a tax filer, the pass-through entity, like a LLC filing a partnership or an LLC filing an S-Corp or a corporation filing as an S-Corp or a general partnership or a limited partnership. Unlike a C corporation, which pays taxes on the entity level, a pass-through entity is a tax filer, but it's not a taxpayer. It passes the income on a Schedule K-1 to you, the owner, which generally is an individual, and you pick up that summary income by category, like interest, dividends, short-term capital gains, long-term capital gains, ordinary business deductions. You pick that up on your individual return in summary form. So let's look at the best tax states for traders. These are your 7. These are actually, and I added in one second. Hold on. Yep, these are your 7. Texas, Florida, Washington. Those are the big populous ones. Nevada, South Dakota, Alaska, and Wyoming, the smaller ones. Nevada is pretty big for traders. Now, why do they make my list, the best tax states for traders? Well, I'm not looking at corporate taxes. I'm looking at that S-Corp. We put our clients into S-Corps because then they can pay themselves officers' compensation to unlock the Obamacare health insurance deduction, which can be a big number. Could be, $1,500 a month. And also a retirement plan contribution, which can be well over $50,000. And there's huge income tax savings from those deductions in excess of payroll tax costs for FICA and Medicare. Traders save several $1,000s a year with that S-Corp strategy. So is there any cost of that strategy on the state level? That's the key thing. In Texas, an S-Corp can be subject to franchise tax, but there's a $1.1 million threshold, $1.11 million. Most traders are not going to trigger that. I'm going to go through the details on the next slides. This is just a table, and you saw this table in the email invitation, but you didn't see all the backup to go with it, which you're going to see shortly. So stay tuned. No individual income tax, no estate tax. it is number 12 in the country in terms of sales tax. Real estate tax per capita is not bad. I didn't add that to the screens. I didn't want to distract too much. But I consider it, I don't really say 1, 2, 3, what's best. I kind of listed, there's the best table, and these are them ranked by population. Florida's number 2. No tax on S-Corps or pass-through entities. No income tax on individuals. No estate tax. And a pretty low sales tax. It's not a huge difference, a couple % lower. Washington State, it's the 13th most populous state by population. It's higher than that for us in terms of traders. They do have a business and occupancy tax, B&O tax. I had to fit this into the table columns here. But a pure trading company is exempt. There's no individual income tax. But they do have the nasty estate tax, the highest rate in the country. Most states, if it's high, it's 16%. They go up to 20%. Their exemptions, not the lowest, but certainly it's not that high. It's not like the federal exemption, over $5 million. It's 2.054. And it's number 5 highest state in terms of sales tax. So you got to really look at what's good for you. Nevada, if you live in California and want to move across the border and give up the ocean, and live maybe on Lake Tahoe, then you might be interested in, let me just get rid of a screen here, excuse me. Okay. If you want to live in Nevada, you're not going to have an individual income tax. You're not going to have an estate tax. It is number 13 for the sales tax. And they just passed a commerce tax. But good news for traders. A pure trading company is exempt from the commerce tax. We'll go through a slide about that. Now, South Dakota's, when you look at the best states for business, it's like always number 3. It's none across the board, a low sales tax. And it's very friendly to business. I don't even know if I don't think there's a business tax. So it's really a great state just on financial institutions, like credit card companies. But that doesn't apply to traders. So it's great for traders. You may not have a lot of allure of a place to live. And that's, everybody's got a different lifestyle and what they love. Alaska, again, it's a very low population. Probably some rough winters. It's a beautiful state if you love the outdoors, but it's tax-free across the board. And look at that tiny sales tax. And Wyoming is the least populous state in the country, low across the board and not quite the lowest sales tax. So let's talk about the states, the best tax states. It includes the 7 states that do not have an individual income tax system, all 7 of them. Texas, Florida, and Washington rank high in population, and tax-free may not be enough of a draw to fill up those other states, Nevada, South Dakota, Alaska, Wyoming. So again, our tables of clients kind of match the federal numbers for the top 5, and we talked about that already. So let's get into some details about some of those states. Texas. They have the franchise tax on limited liability entities and trusts. The franchise tax rate is 0.75% for most entities times gross margin. It's not times net income, it's gross margin. That means trading gains. Now, the no tax due threshold is 1.11 million and it goes up each year. Gross margin is total revenue times 70% minus cost of goods sold, minus allowed compensation, minus a no tax due threshold of 1.11 million. So basically, traders don't have revenues. They don't have inventory, cost of goods sold. They start with the trading gain there. Then they subtract. Then they do the 70% calculation, subtract compensation, subtract the no tax due threshold. So you got to make a lot of money. You're talking like over $1.5 million to trigger this. So most traders are not going to owe it. And there is no minimum franchise tax, like some other states that have minimums. So basically, If you're trading in a small S-Corp, you're not if you're making $500,000, $1 million in your S-Corp, you can max out on all your employee benefit plan deductions and not worry about this tax. Now, Texas exempts general partnerships from franchise tax, providing they are owned entirely by natural persons. But you can't achieve employee benefit plan deductions with a general partnership because of Obamacare, quirks of Obamacare. We've covered that in prior content. You need the S-Corp. So there are exempt entities from the franchise tax. Passive entities, including partnerships and trusts, other than business trusts, may qualify as a passive entity if at least 90% of the entity's federal gross income is from net capital gains. Unfortunately, an S-Corp does not qualify as an exempt entity. You'll see a trend here in every state. You always want to see, well, do they include trading gains in the base? Is there an exemption for trading somehow? It's different in every state. So you got to look for our content, which tells you the answer. The S-Corp is not exempt, but it's for all practical purposes, you're not going to pay unless you're making a lot of money. And you need the S-Corp for the employee benefit plan deductions. Let's talk about Washington State. It has a business and occupation tax, B&O. It's assessed on gross receipts from business activities. Again, some states use gross receipts, others use margin. In both cases, it's really trading gains. Tax rates vary by classification, with the highest rate of 0.15% applying to a service business. There's good news in Washington. They exempt a trading company from B&O tax, providing it does not have other types of income like management fees or profit allocation, carried interest in a hedge fund. We always like a retail trading business to be pure. We don't want you to have your management company also a business conducted in that entity. It confuses the IRS. And it would confuse Washington. They would say it's tainted because you're getting a carried interest, a profit allocation, or a management fee, and that all of a sudden it is subject to B&O tax. It's not a big rate, but again, it's better to be exempt. Washington, again, has that highest estate tax rate, 20%, and fairly low exemption. So it's a good tax state for traders to live in, but not a good place to pass away if you expect to exceed the estate exemption. Now let's talk about Nevada. It enacted a commerce tax new this year on businesses with a Nevada gross revenue exceeding $4 million. So it's for the big boys. Some people might have a $5 million gross revenue business and then a low income. Now here's the good news. Passive entities are exempt if 90% of income is portfolio income, including capital gains from the sale of real property, gains from the sale of commodities traded on a commodities exchange, and gains from the sale of securities. That's a trading business with or without trader tax status. A pure trading business will be exempt. Nevada does not have an individual income tax. It does not have an estate tax. It's one of the best states for traders. Now let's look at the worst tax states for traders. They tend to have high individual income tax rates and estate taxes. I kind of think New Jersey's number one is the worst. It's not the highest tax state. It's only the 11th most populous state. But they have high minimum taxes on the S-Corp. Their rate is 8.97%, which is higher than, goes up to that, higher than, it's pretty high like its neighbors, like New York. But it doesn't allow losses of any kind, and traders have losses in certain years. The estate rate is up to 16%. There's a low threshold exemption, $675. It has an inheritance tax too. And the sales tax is not that bad. It's number 24. It's close to 7% on average. I kind of say California's in this list as well because they have a 1.5% franchise tax on the S-Corp. There's an $800 minimum tax. And there are ways to navigate around it with a dual entity structure, but then it's more complicated and costly. Their progressive tax rates go up to 13.3% if you make over $1 million, and it's pretty high throughout the brackets. Good news is no estate tax, and it's a pretty high sales tax rate and a high cost of living. I mean, California's up there, but a great quality of life. Also, I have New York State/City on the list. New York City has that darn 8.85% general corporate tax. They don't recognize the S-Corp. The combined rate between New York State and New York City goes up to 12.7% if you make over 2.125 on New York State. The highest bracket kicks in a lot earlier for New York City. There's up to 16% estate tax if you go over the estate threshold of 3.125 million, and they have some changes brewing on that. And it's a pretty high sales tax rate as well, 8.49. Massachusetts, they have a small CET tax, 0.26%, and it does kick in on the S-Corp. There is a minimum as well. We'll cover that shortly. That's not too nasty. What bothers me about Massachusetts is they give a tax rate of 5.1% on just about all income except short-term capital gains. And if you elect Section 475 mark-to-market accounting, it fits in there too. That's a 12% rate. That's high. And they have an estate exemption of just $1 million. It's like second lowest in the country. And it goes up to 16%. Sales tax, 6.25%, not too bad. Let's talk about some of these states. The worst states table includes states with a high individual tax rate and minor tax regime applicable to S-Corps. All have high estate tax rates and low exemptions, except California, which does not have an estate or inheritance tax. These states also have high sales tax rates. Let's talk about New Jersey. New Jersey has an S-Corp minimum tax based on New Jersey gross receipts, which includes net trading gains. It is $375 for less than 100,000 gross receipts and $563 for less than 250, $750 for less than 500, $1,125 for less than 1 million, $1,500 if under 1 million. So if you have an S-Corp and you're making some good money, you might pay $750. That's not bad. It's kind of a nuisance. I don't put it on the list because of that. And you're not going to have a dual entity because of that. That's kind of a nuisance tax. New Jersey has a progressive individual income tax system, and the top rate is 8.97% on income over $500,000. So it kicks in pretty low. New Jersey individual, or not actually 500 is not pretty low. That's fair. New Jersey individual income tax rates are lower than New York State/City rates. But many traders pay higher taxes in New Jersey because it does not allow deductions for losses. That includes business losses caused by trading business expenses, net capital losses, and net Section 475 ordinary trading losses. New Jersey only allows certain itemized deductions. You get the drift. New Jersey is cutting out your losses and putting them onto the cutting room floor, including capital loss carryovers. Traders know. You have a good year, you have a mediocre year, you have a bad year. You need to be able to average this stuff out. When you get disenfranchised from your losses, that's a bad deal. That's not a good state for you. So, New Jersey's restrictions on deductions translate to higher effective tax rates. Many traders have net losses in some years, and they do not find tax relief in New Jersey. Some people want to be in New York City. They go through a lot of hoops just to take the ferry to be in New Jersey, thinking they're getting a better tax deal, only they didn't. It's kind of sneaky. And, maybe that says something right there. New Jersey summary. It has an estate tax rate up to 16%. An exemption is $675, which is the lowest exemption in the country. It also has an inheritance tax up to 16%, with high individual tax rates, disallowance of losses, high minimum taxes on S-Corps, and the lowest estate exemption in the country, New Jersey is one of the worst tax states for traders. Let's talk about California. I don't like to pick on California because it's the number one, it's the biggest state in the country. It's an economy in its own right. So much comes out of California. It's one of the great American states. I mean, I don't want to pick on New Jersey. I just don't think it's good for traders. California has high taxes. They also have a lot of quality of life. I mean, it's your choice. Taxes are not everything. We'll talk about that later with some poll questions. S-Corps owe franchise tax, which is the greater of 1.5% of net income or $800 minimum tax, even in a short year. The 1.5% franchise tax rate is meaningful, so it is important for traders to reduce it. There are two ways that we advocate. Trade a smaller amount of funds so you do not owe franchise tax above the $800 minimum. Here's an example. You trade $50,000, $100,000, $200,000, $300,000. You figure if you make $200,000, you can pay yourself wages of $140,000 to unlock the retirement plan contribution for a solo 401k of $53,000 or $59,000 if you're over age 50, plus your health insurance deduction. So if you're making $250,000, $300,000, you're mostly wiping out that income with these deductions. And you're not going to pay franchise tax until you make over $53,000 because 800 divided by 1.5% is $53,000. So if you're not going to make over $300,000, you're not going to need the second recommended solution, and that's the dual entity structure. A trading general partnership, which is exempt from franchise tax, and an S-Corp management company for the employee benefit plan deductions, which ends up having lower income and thereby lower FT. Most trading income remains in the general partnership free of FT. A little later in this presentation in Illinois, which has a similar situation with replacement tax, I explain a little bit more how the dual entity works. I also explain it in full in the blog post about California versus Texas. So I show you how the partnership is going to pay an admin fee and a profit allocation to the management company, which hopefully gets their target amount of income it needs for the employee benefit plan deductions. It's far more complex. Doesn't always work out the way you want it to. It's not what you want to do unless you really want to save franchise tax. And that's only an issue if you're making $1 million. It's not an issue if you're making 300 when you just need the one entity. And you can max out on the employee benefit plan deductions to avoid franchise tax. If you get stuck with some franchise tax at the end of the day and you save payroll tax, you don't do the employee benefits, it's not the end of the world. There still can be some nice savings. Talk to us about it. It's something you got to deal with. The California 1.5% franchise tax on S-Corps. There's more stuff to deal with in California. California is almost like a country of itself. It has a complex tax code. It's got an active franchise tax board. It's our biggest state market. We spend a lot of time dealing with California issues. We've battled the California Franchise Tax Board on trader tax status issues and won. So there's also an LLC tax. An LLC owes the $800 minimum franchise tax, but not the 1.5% franchise tax rate paid by S-Corps. Instead, there's an LLC fee. It's based on gross income. If your gross income trading gains are between 0 and 250,000, it's zero. So most traders, it's zero. If your trading gains are between 250 and 500, it's 900. If it's under $1 million, it's 2,500. If it's under 5 million, it's 6,000. And if it's over 5 million, it's 11,790. Very few of our clients have paid the LLC fee. Gross income includes the net trading gains. So we've pivoted recently to forming corporations to elect S-Corp status as opposed to the LLC electing the status. You might do a little bit better with the LLC fee. And also the first year, you could be pardoned from paying that $800 minimum tax with the S-Corp, going through the C-Corp route. So check with us about all these things. This is just a main overview, and check the blog post for more details. So let's talk about the California summary. California has a progressive individual income tax system, and the top rate is 13.3% on income over $1 million. On income over $50,000, which is really pretty low, but a lot of traders have, the marginal rate is 9.3% for a single filer. That's still high. California has that 1.5% franchise tax on S-Corps, and with high income, traders use a dual entity solution, but that is more complicated and more costly. So, California is our biggest market for traders. Many people who work in Silicon Valley start trading businesses. Some trade part-time and retain a day job. Spouses and families want to remain in California. At least there won't be an estate tax. So, stay in California, but do the best you can on your tax returns. Avoid the franchise tax and take advantage of deductions to keep your tax rates, taxes low as they can be. If you want to move to Nevada, you're going to have to move lock, stock, and barrel. Like New York, your high tax states dedicate so many resources in their tax departments to non-resident taxpayers of the state, residency versus non-residency issues. There are very strict rules with lots of court cases. You need to read it and be conservative about it. That will come up when I discuss New York State and City next. In New York State and City, you can have an S-Corp for federal and New York State tax purposes. But New York City will disregard your S-Corp tax status and treat it as a C-Corp, a regular corporation. That means your S-Corp owes New York City general corporation tax, GCT, of 8.85% on net income. You can try to reduce it with good old-fashioned C-Corp type strategies like payroll. So first, reduce net income with deductions for officer compensation and employee benefit plans. If your income is over $200,000, which seems to be the sweet spot, you may trigger alternative tax, which requires adding back officer compensation for an alternative GCT calculation. New York State and New York City have progressive individual income tax systems. The top New York State rate is 8.82% on income over $2.1 million. That's pretty high. The top New York City resident rate is 3.876% on income over $500,000. So a New York City resident has a combined tax rate of 12.7%. New York State has an estate tax rate of up to 16% and an exemption of $3.125 million, which is below the federal exemption of $5.450 million. That's the federal exemption for 2016. It goes up each year. And the New York State sales tax is pretty high too. So a lot of New Yorkers think about moving. I mean, many traders working for banks and hedge funds work and live in New York State City. But online traders often move to a tax-free state like Florida to avoid high state city taxes on S-Corps, individual income, and estates. It is not easy to change your tax residence away from New York State and City or California. Read my blog post, Bill de Blasio's, he became the mayor of New York City, Tax the Rich plan. I wrote about it during his election season. And recently I wrote about it again in the Trader Tax Battle of the States, New York versus Florida. Go back to some of those blog posts to read about how difficult it is to change your residence. You have to, if you're going to change your domicile, you got to pretty much sell your place of abode and move lock, stock, and barrel with your family, with your job, with your economic nexus to the tax-free state, away from your high-tax state. Years later, you can come back and get a little place of abode, a little pied-à-terre, but then you're going to go into the statutory residence rules, which give you more days. In New York, Domicile rules are 31 days. Statutory residents are really 183 days. Florida wants 183 days for residents too. And then there's a lot of things to go through. So it's not easy. This reminds me of when we talked about Puerto Rico. One of my clients today said, Bob, isn't Puerto Rico the best? But it's not a state, so it's not in today's presentation. It's a possession. Because if you live in Puerto Rico, they don't tax capital gains. So moving is easier said than done. It's not a case of just buying a second home in the other state and getting a driver's license or registering to vote. These states are very smart. Nexus is a complex area of the tax code. You can't pull a fast one on them. You have to move lock, stock, and barrel. And consult with your accountant about it and be conservative. Consult with us about it. Let's move on to Massachusetts. So Massachusetts has an S-Corp, 0.26% corporate excise tax, CET, on taxable net worth. Now notice some states are using gross receipts, others are using margin. Others use equity, net worth, tangible property. Massachusetts is one of those. So the minimum CET is $456, which translates to $175,384 of taxable net worth. Just take 456 divided by 0.26%. That's not that bad a tax. I mean, if you have taxable net worth of $500,000, it's a bigger number. Again, it's a nuisance. It's meaningful. It's not enough to move out of the state. The bigger thing that bothers me about Massachusetts, as I pointed out before, is most MA residents pay individual income taxes at the 5.1% rate, which is competitive. But traders owe the higher 12% rate on short-term capital gains and Section 475 ordinary income when business traders make that election. And I think that high rate makes Massachusetts one of the worst tax states for traders because it's a flat rate. It's not a progressive rate. It kicks in on that first $50,000 of trading gains. That's kind of outrageous. Now, Massachusetts also has a very low estate exemption of $1 million and a pretty high rate of 16%. So I don't really like Massachusetts, and don't think you're just going to move over the border to New Hampshire. Because if you want to set up your S-Corp in New Hampshire, you have the business profits tax of close to 9%, over 8%. And the business enterprise tax, that's in the blog post, not in the webinar today. If you don't have the entity, New Hampshire is good for traders because you don't have a lot of interest in dividends and capital gains are tax-free. Decent tax states for traders. There's a lot of those. They don't rub me the wrong way. They're not on the worst list, and they don't super impress me. They're not on the best list. They're in the fair, they're decent. And if you like where you live, it's a decent rate. And the rest of the top 10 states fall in this category between 6 and 10. So you got Illinois, Pennsylvania, Ohio, Georgia, Michigan, and North Carolina. So between 5 and 10. So Illinois has a 1.5% replacement tax. It's similar to California's franchise tax. They just use a different word. The same strategies apply. It's a little different. We'll go over that. Illinois has the flat rate. They do have like some of the Northeast, New Jersey, Connecticut, Illinois, they have fiscal problems. They face a crisis. Things could change. If Republican governors get swept out of office and Democrats get in there, they could raise taxes. They've threatened a financial transactions tax in Illinois. So, the politics are not great. But right now there's a flat rate. If you're making not that much money, you may not appreciate a flat rate. But if you make a lot of money, you may appreciate it. State taxes, decent exemption, $4 million. High sales tax. So I'm not saying that Illinois is the best of this grouping, but I'm listing them by state ranking. So really you got to navigate around the replacement tax, which I'll show you how to do. Pennsylvania, no tax on S-Corps. They repealed the capital stocks tax. Again, a flat rate, decent inheritance tax, no estate tax, it's an inheritance tax, decent sales tax. Ohio, very decent state for traders. The top rate, close to 5%. They got rid of those entity level taxes, just the minimum now. Georgia, they have progressive rates. Look at that. But on $10,000, come on. They may as well just call it a flat tax. There is a net worth tax, but it's reasonable. It's not even really that big a nuisance. Michigan, they used to have this whole assortment of, single business tax, master business tax. They got rid of it all. 2016 is the clear sailing year. A lot of this stuff on a lot of these states was phased out over many years. By the end of 2015, there's clear sailing now in 2016. Michigan has the flat tax, flat rate, decent on sales tax, no estate tax. All these states that you used to think weren't so good for taxes aren't that bad anymore. So if they can just get back the jobs, they could be good state, they could draw people again. North Carolina, they have a franchise tax. If you have a lot of money in North Carolina, it's a really high tax. We had a client this year who didn't like that, but otherwise, if it's not a lot of trading capital, it's not bad. A little bit of a higher flat rate, not too bad. Let's go through these states in specifics. Let's do a sound test here. Testing 1, 2, 3. That's good. Okay. So the decent states table includes states ranked by population from 5 Illinois to 10 North Carolina. Notice they are Midwestern and Southeastern states. Many of the Midwestern states reformed their tax regimes to repeal business taxes on pass-through entities, including S-Corps, and lower individual income tax rates and flatten them out. They seek to slow the exodus of residents to more tax-friendly states. Hopefully that gamble works and they don't go into fiscal crisis and it works long term. For some of these states, it's something new, the repeal. Traders can always move. I mean, if they really are virtual. If your spouse is, landed in the ground with a job and your kids are in school and you may not be that, portable. But if you're single, young, and just trading, you are portable. So Illinois has a 1.5% replacement tax on partnerships, trusts, and S-Corps. Good news, there is an exemption for an investment partnership. An LLC filing a partnership return qualifies for this exemption, but an S-Corp does not. Illinois just did not want to extend it to the S-Corp. A lot of trading companies do file partnership returns, but if you want to create the opportunity to have the employee benefit plan deductions, you need the S-Corp. And then all of a sudden, bingo, you trigger the replacement tax. That's not good. The 1.5% replacement tax, the RT rate, is meaningful, so it is important for traders to reduce it. This will remind you of the California slides. There are two ways. Trade a smaller amount of funds in an S-Corp so you do not owe significant replacement tax. Again, you make a couple $100,000, you do the officer's compensation, the retirement plan deduction, the health insurance, your income ends up pretty low, and you pay a little bit of replacement tax. It's not like the $800 minimum tax in California. You pay maybe $100, $200, whatever it is. You try to work down the income to a low number. But if you make a lot of money, then you want to consider the alternative dual entity structure because you have larger amount of capital, you expect high income. So you need the dual entity structure, a trading general partnership, which is exempt from replacement tax, and an S-Corp management company with reduced replacement tax. Hopefully you're all sticking with me. We're almost through some of these difficult slides. We're going to get into some really interesting stuff more lively shortly. So stay tuned here, especially on your states that are of interest to you. I explained to you how to do this before with California. The entity partnership pays the admin fee and the profit allocation. Bottom line, you end up with very little income in the partnership. That's exempt from the replacement tax. And you have a little income in the S-Corp, which pays a little replacement tax. So again, Illinois has a flat tax. It's a low rate. Not bad on the estate tax. Not bad on the sales tax, although it is 7th highest. Again, a lot of traders are in Illinois because, like New York City, they live near or in Chicago, close to the futures exchanges. So while most people do not think of Illinois as a decent tax state with its 3.87% flat tax rate on individual income, it's competitive. And traders can navigate around replacement tax. Pennsylvania. They used to have a capital stock tax. It wasn't too bad. It was like one of those net worth taxes, but they repealed it. They phased it out. As of 2016, it's completely gone. 3.07 flat tax rate. That's nice. No estate tax, only the inheritance tax. Not a bad state, but yet a lot of traders don't live in Pennsylvania. Or if they do, they don't work with us. Ohio and Pennsylvania have these local school taxes, which I didn't put in here. So if you get the wages from your entity, you could trigger a little bit of that. Ohio had the commercial activity tax, 0.26%, CAT. It's based on taxable gross receipts. But taxable gross receipts do not include interest, dividends, and capital gains. Those are excluded from the taxable gross receipts. So in a sense, you're going to wind up paying the minimum CAT of $150. Got a progressive income tax system up to 4.99%. They want it obviously to be under 5%. I think that sounds like 5%. Not too bad. No estate, no inheritance. Not a bad state for traders. You don't have to move from Pennsylvania and Ohio. Georgia has a net worth tax. $100 if it's on $100,000, $250 on less than $500, $500 on less than $1 million. Again, one of those nuisances, not too bad, not enough to move. Okay, it says they have a progressive tax system, but the highest rate's at $10,000. Did I read that right? That doesn't sound progressive. Georgia does not have an estate or inheritance tax. Not a bad state for traders. They'll tax your non-resident owners, but a husband and wife don't have any non-resident owners. Michigan used to have all those crazy taxes, single business tax, master business tax. They got rid of it all. Does not subject S-Corps and partnerships to corporate income tax unless it's a financial institution or insurance company. A trading company is not that. Michigan has a good individual income tax regime, 4.25 flat rate, no estate, no inheritance. North Carolina has a 0.15% franchise tax on the S-Corp. Appraised value or North Carolina tangible property, basically your equity, your trading capital. The minimum is $35. No problem there. If you have $100,000, it's $150. But if you have a couple $1 million, it adds up. And we had a client like that, so he didn't want to do it. He didn't want the dual entity scheme, so we just didn't do an entity. I think the dual entity scheme made sense, but he just didn't want to bother with it. North Carolina has an individual income tax system, 5.75%. That's a higher flat rate. It's higher than some of those Midwestern states that were closer to 3%. Remember, it applies even on the low amount of income. So if you're not making a lot of money, that flat rate, you may not appreciate it that much. That's a nice thing about progressive rates. But if you're married with a marriage penalty and your spouse has a nice income, your income is kind of taxed at the marginal rate. You don't get to take advantage of the lower rates again. That's why there's a marriage penalty. They call it a marriage penalty because they don't just divide the rates in half. North Carolina does not have an estate or inheritance tax. Not a bad state. Now, there are other state tax issues to deal with. Most states start with federal law and then depart from it with modifications and credits. So most states couple their income tax regimes to federal tax law. States start with amounts reported on federal tax returns, including revenue, expense, gain, and loss. They're not going to start redefining what a capital gain is or what inventory is. Yet several states require modification adjustments for adding to or subtracting from gross income or adjusted gross income to reflect their preferences. For example, a state may allow less of a deduction. Some states limit itemized deductions, sometimes phasing them out at higher AGI amounts. States also offer different types of tax credits to incentivize taxpayers. Now, when you compare states, It can be apples and oranges, like I did today with New York versus New Jersey. There's other tax issues as well. It's unusual, but possible for a state to audit and challenge a trader's qualification for trader tax status, which unlocks business expense treatment. Usually that's the domain of the IRS. California has challenged trader tax status, threatening 475 ordinary loss treatment. CPAs can sign tax returns and represent clients before the IRS or before the state authorities in all 50 states and the District of Columbia. Our firm has trader clients in all 50 states and the District of Columbia. Next steps. Contact us about consultations, tax compliance, and entity formation services. We're going to get you your questions next, so stay with us. So consider our tax compliance service, which includes tax planning and tax preparation, which we offer in all 50 states and District of Columbia. If we represent you in an exam in California or any state, we do it by fax, mail, and FedEx with the agent, or email if they use email. Many don't. We don't have to be there in person. It works out great this way. If it's a federal IRS matter, we can transfer an appeal back to our Alabama office where we know the IRS appeals officers. They know trader tax status, and we have a great record with them. Many traders file 2015 tax extensions, and there is still time to engage our CPA firm for 2015 tax compliance. So you're on extension, your entity return is due September 15th, your individual return is due October 15th. You still have time to sign up with us. Don't wait, you'll miss our internal deadlines for getting the work done. Do it right away. Now, you want to talk about all these things? Consider a 30-minute consultation with me. Read about the testimonials. I don't waste any time. It's all meat on the bones. I listen to you, and then I tell you what I think about your situation. Consider our entity formation service if you're going to have an entity in a given state. So just go to greentradertax.com. There's a wealth of information. Give us a call. Julie Cowan is truly a pleasure to speak to. She's wonderful. She'll listen to you, take her time, point you around our website, tell you how we can help you, tell you next steps. Give her a call. Chat with her, Send us an email. Thank you, everyone, for coming today to our webinar and listening to the recording afterwards. And we hope to hear from you soon. Have a great day.